Bon matin, good morning. I just want to introduce my subject by giving you some history on why we picked this topic for the presentation. So I was asked to do a presentation this morning on a topic of my choice and thought long and hard and decided that corporate rollovers would be a good subject this morning for two reasons. One is that rollovers are extremely important in tax planning and advising clients. It's really the backbone of what we do. In the corporate world, we often see movement of property, transfer of businesses, transfer of shares, and then the rollover is very, very key to achieving a tax-efficient transfer. The second reason is that my colleague Pierre-Louis is going to talk about, how to fix mistake, and often mistakes are done through missing on the rollover provision by not necessarily following the rules that are important for the transfer to be effected on a rollover basis. So with that, I'm going to go to my first slide, which is, this one. Definition of a rollover. So a rollover is different than an exemption. An exemption is really when a transfer is done and no tax liability is imposed. So that's an exemption. One example of an exemption is on a sale of by an individual of small business shares. There is a lifetime capital gain exemption that you may have heard of, where more than 800,000 of the gain can be completely exempted from tax. A rollover is not that. A rollover is more a deferral of a gain on a transaction, such that the gain will be realized later, assuming that the gain is still a gain at the time of a later disposition. And the gain is basically a very simple concept. It's the price that you receive for the property minus the cost, and that gives you generally the gain. In very simple terms, and the tax rate on gain could vary between 13% to 53%. So very important to think about deferral and rollover on transfer of property in the corporate context. The basic rule is that if property is transferred from and to a corporation, the transaction will be taxable, and taxes will result on the gain. Rollover is essentially an exception to this general rule. Last bullet, in a corporate context, rollover is often achieved on an exchange of share, or requires that share be issued. So that's one condition for rollover in the corporate context. And another sometimes requirement is that a tax filing form be filed with the tax authorities subsequent to the transfer. This presentation is not exhaustive of all the possible rollovers that are out there in the Canadian corporate context, but we're just going to touch on what are the most important ones and provide some general comments, so that maybe you're aware that if this is done, maybe there's a way to avoid tax and to avoid but defer it to a later time. So the most common form of rollover is when a taxpayer, could be an individual, could be a trust, a partnership, transfers eligible assets to a Canadian corporation. So taxpayer transfers the property has a significant gain, and then receives in exchange for the transfer shares of the Canadian transferee. What's interesting with this transfer of assets under Section 85 is that the taxpayer, the transferor, can receive consideration other than shares. So the transfer could receive some cash and shares. One share only need to be issued. There's no magic number to the number of shares to be issued. And the non-share consideration, which could be in cash, has to be not in excess of the cost of the property transferred, because if it's in excess of the cost of the property transfer, then there would be a partial gains realized on the transfer. This form of rollover requires an election to be filed, and in the election form you can decide the price the price that you want to elect for the transfer within certain parameters. So typically the price for the transfer would be the cost, so that there's a perfect deferral, and for the transferee company, which is Canco in the example, it basically steps into the shoes of the taxpayer, and the cost of the property to Canco is the cost of taxpayer on the transfer. So the first question is, to determine whether this is worthwhile to do is, what is the value of the property being transferred, or what is the price that the property is transferred at? That's the first question. And then the question is also, what is the cost of this property? And then that helps in the determination of the gain. So in one very important rectification case that Pierre-Louis is going to talk about, or maybe you'll skip on that one, but it's the Juilliard case where two sisters transfer their shares of a company in which they operated a convenience store business to each of their respective holding company. And one sister had one share issued and was properly advised, and she effected a rollover. The other sister received a note on the transfer, no share, and ended up with a taxable transfer when the intention was to have a non-taxable transfer. So Pierre-Louis is going to go on to later on to explain how this situation can sometimes be fixed through a court process or some other ways. The second form of corporate rollover is when a taxpayer has common share of a corporation and would rather have a preferred share, perhaps in the context of freezing the value of the common share by, replacing the common share with a preferred share. So that's a very common type of rollover, and the way it's achieved is simply by doing a corporate reorganization of the corporate structure of the company, and then through that process exchange the common share for the preferred shares. So for this kind of transfer to work, it's very important that all the share of taxpayer, all of the common share be transferred for preferred shares. So if only half of the shares are the common shares are transferred into preferred share, this Section 86 rollover is not going to work out. So very important that all the shares be transferred, and no election is required. So that's a very convenient way to effect a rollover. If ever there was a problem because not all the shares were transferred, or there wasn't a corporate reorganization of the capital, then there may be a way to effect a Section 85 rollover where the corporation and taxpayer one would file an election form and therefore rely on the rules under 85 instead of 86, because all these rollovers sometimes overlap, especially 85. 85 is kind of a very general rollover, which requires the filing of the form. Other more specific rollover do not require the filing of a form, and it's possible then to overlay an election under 85 to correct a missed Section 86 exchange of share. This one is very similar to the previous one. It's when shares are converted. So the same situation, a shareholder has common share, wants to exchange his common share for, say, non-voting share or multiple voting share or a preferred share. So that does not require that all the shares be transferred. Only half of the shares can be transferred, and no election is required. The difference between this one and the 86 is that only share consideration must be issued. So if there's $1 given to taxpayer 1 or even a cent given to taxpayer 1 on the conversion of the common share into preferred share or a different type of share, then this rollover is so-called busted and transactions taxable. So to fix that, then maybe file a Section 85 rollover. The Section 85 rollover can be done not just on a transfer to another corporation of share, but it can also be done in putting the share back to the corporation that issued the shares. So in this example, the shares are essentially converted by the corporation that initially issued the shares. So if 51 doesn't work, then consideration should be given to effect an 85 election form to avoid the gain. Section 85.1 is another rollover that is important, and that is a rollover that applies in the context of arm's length relationships. So the parties are not related. So in the slide, you'd see that taxpayer is not related, is at arm's length with Canco 2 before and after. So in that case, no rollover election is required. Only share consideration again. So if there's a cent given on the transfer by Canco 2, then there's the transaction is taxable for taxpayers, which may not be a good thing if a taxpayer was expecting a rollover. And what's good about this election under Section 85.1 is that the transferor can decide what value to use on the transfer to Canco 2 just simply by indicating in the tax return a sale price that would result in recognizing the gain on the shares, on the transfer shares of by taxpayer of Canco 2, of Canco 1 and Canco 2. If a cent is given by Canco 2 or very small non-share consideration, then the rollover doesn't work under 85.1, and a way to fix it is to file a Section 85 rollover and rely on the more general, more broad Section 85. In public transaction, when shares of public companies are transferred to other public companies for shares, this is sometimes a rollover that's relied on so that, when there are many taxpayer transferring, sometimes filing an election form for each of the transferors is a very big job. So by ensuring that there's no boot or non-share consideration and it's all share for share, this is a very interesting rollover. Partnerships. So here the same kind of concept with partnerships. So taxpayer wants to transfer assets to a partnership. A partnership is a contract. It's people signing a contract, acting in common to carry on business. But for tax purposes, partnership in the computation of income is treated as a person, and there are many rollover provisions that deal with partnerships. So it's a different section. It's called 97.2, but it's very equivalent to 85, the first rollover that we looked at, where a taxpayer decides to transfer eligible assets, including share of a corporation, into a partnership in exchange for units or an interest in the partnership, and there could be cash consideration also. But the cash consideration should not exceed cost, because otherwise that would be partially taxable. It's not a cliff. Like in 85.1, where it's a cliff. If you just give a cent, then the whole transfer is taxable. And 51 is also a cliff, that if you're giving consideration other than share, the whole gain is recognized. This is like 85, where non-share consideration or non-unit consideration can be issued without affecting or canceling the deferral for the 100% of the gain. This is another rollover where instead of transferring asset to a partnership, partners want to dissolve the partnership. So there's a mechanism to effect this without incurring the gain, the accrued gain on the assets of the partnership. So, and the way it's very particular, each partner of the partnership need to receive a non-divided interest in each of the asset of the partnership. So it's not just, transferring one property to one taxpayer, another property to another taxpayer. It really, each of the partner must receive a non-divided interest of each of the assets of the partnership in order for the partnership to be dissolved on a tax-deferred basis. So after the transfer, so that's the image on the right-hand side of the slide, after the transfer, each taxpayer owns a non-divided interest in each of the assets. So it's like a co-ownership between partners on the property of the partnership after the wind-up of the partnership. Another very common rollover is if one partner of the partnership decides to continue the business as a sole proprietorship. So in that case, that partner gets a rollover, not the other partner, not in my example, taxpayer 1, but if taxpayer 2 owned 99% of the interest in the partnership, then there's a rollover for that partner who continues the business as a sole proprietorship. No election is required. So there's a way also to unwind a partnership, which is by incorporating, and that's used very often. So instead of doing the undivided interest in each of the asset by the partners, this is a different type of rollover where the partnership transfers to a corp under an 85 rollover. So the partnership transfers all of its assets to a newly formed corporation, CanCo on the slide, files an election form because it's a Section 85 rollover. And then, not immediately after, but within a period of 60 days, partnership is dissolved. And the partners, the taxpayers, or the old partners receive shares of a company. And on the wind-up of the partnership, that does not require an election form. So that's kind of a two-election going on, a Section 85 election in the first place on the transfer to CanCo, and then the partnership can be liquidated without by distributing the shares and providing for a rollover. So these are kind of typical consolidation, or when corporate groups want to simplify or combine their business. So taxpayer A and B can basically amalgamate their respective company into one, and that's a common transaction and does not give rise to any tax for taxpayer A and B. Another form of corporate simplification is taxpayer A wants to amalgamate A and B. They're This is called a vertical amalgamation, so that's no election is required, and the two corporations can amalgamate to form Kenco AB. Another way to do it is by winding up. Let's assume that the taxpayer wants to combine the business of Kenco B with the business of Kenco A. So instead of doing an amalgamation, a vertical amalgamation, Kenco B can be liquidated into Kenco A, which means all the assets and liabilities of Kenco B are transferred to Kenco A, and then Kenco B is dissolved. And the same result where taxpayer now has Kenco A with the assets and liabilities of both businesses, Kenco A and Kenco B. In the foreign context, here is a situation where a taxpayer owns a foreign affiliate. A foreign affiliate is where a taxpayer would own generally more than 10% of the shares of the foreign company, and would want to transfer the shares of that foreign affiliate to another foreign affiliate. So that works. It's share for share, and no election is required. And there could also be other consideration. So even if there are like some cash paid on the transfer, it's not a cliff. There could be some gain recognition, but the gain could still be deferred. There are some exceptions to the rollover, and one example where things are not working, and then that's a difficult fix if this happens, is when you have a taxpayer, and the taxpayer could be a corporation owning a partnership, and the taxpayer wishes to integrate the business of the corporation with the partnership business, or liquidate the corporation into the partnership. So there are no rollover provision in the Income Tax Act to deal with this situation. It's kind of a glitch, because there's no reason from a policy perspective not to provide for a rollover in that context. And we do have a situation here where the client operates through a big partnership, and there are many partners of that partnership, and they acquired corporations over the years from individual that wanted to have their capital gain exemption. So partnership acquired a multitude of corporations in the same business as the partnership, and then wanted to unwind these corporations to consolidate the business of the corporation with the business of the partnership, and carried out all these wind-ups of the corporation, and ended up with a big audit with the Canada Revenue Agency on the basis that there are no rollover provision for this situation. And so we'll hear about Pierre-Louis, what kind of solution for this, but it's not a good situation at all. Another problem also is when when a taxpayer owns shares of a Kenco, and then a foreign buyer, a foreign co, wants to buy the shares, and that happens often. This is a kind of a cross-border acquisition of Kenco shares. So, but the taxpayer receives share of foreign co, so there should be a rollover, because eventually taxpayer will sell the share of foreign co and realize the gain. So it's not like the gain's going to disappear into thin air. And and there should be a rollover provision allowing taxpayer to transfer its share of Kenco to foreign co in exchange for share of foreign co, keeping a cost base, a low cost base, or the historical cost base that it had in Kenco share in its share of foreign co, and be able later on to realize the gain. So that there are no, right now, provision in the Income Tax Act that allow for this, but there's a way around. So there's a workaround, and the workaround is essentially Canco, which was the company, the share of which were transferred by the Canadian taxpayer, would do an 86 rollover, exchanging the common share that the taxpayer had into a so-called exchangeable share. And that exchangeable share could be exchangeable on a one-for-one basis for share of foreign co at the time where the Canadian taxpayer would want to, exit and get his money back. So, so here, using a Section 86, Canco issues in exchange of the common share, exchangeable share of Canco, and the exchangeable share, because they're exchangeable on a one-for-one basis with foreign co-shares at any time, then it's as if Canadian shareholders holding shares of foreign co, but getting a rollover because the shares are in fact shares of Canco, and therefore eligible to a rollover under Section 86. So those transactions are often done when a Canadian buyer wants to buy shares of Canco, and Canadian buyer offers Canadian taxpayer or the taxpayer share of foreign co in exchange of the share of Canco, and then Canco would realize a gain. So this is a way to achieve a deferral using Section 86 and allowing the taxpayer to still enter into this transaction with the foreign buyer and defer the gain. So key takeaways is that tax efficiency is always a primary purpose in, or a primary objective in any movement of business, assets, investments, and transaction. Rollover are very important because through tax deferral, it reduces the tax burden on taxpayers, and rollovers are available for a lot of situations where shares are issued on transfer in and out of corporations. So that's my presentation.
Before, excuse me, before we move on to the other topic, is there any question, or because my topic is a bit different from Marie-Andrée's topic, so it would be a good time if you have questions on rollovers. Yes?
Thank you. On the winding up under 88, as you were explaining B into A, will the wound up corporation as the taxes losses?
Yeah.
Will A be able to use even if the businesses are not? I'm going to use the word similar.
Yes, losses will be available if the wind up. Is this the slide that you were referring to, where A and B, and then the business of B is liquidated into Canco A? Yes, there are rules that would allow the loss of Canco B to be available for Canco A going forward in reducing taxable income of the Canco A and B business.
Thank you.
And just on this slide, if ever there was another shareholder of Canco B, then the rollover would not work. So if ever, a bit like the partnership situation where where a corporation liquidates in a partnership, if Canco B had numerous shareholders and wanted to effect a wind-up, that would be taxable. So Canco A would recognize a gain on the shares, and Canco B would have a disposition of its assets at fair market value on the transfer of the business of its assets and liabilities to Canco A. Furthermore, the loss would not be available. If Canco B had losses, historic losses, they wouldn't be available for Canco A. So it's very important that Canco A and Canco B be a wholly owned subsidiary of Canco A. There are some exceptions, but they're very rare exception, and so care must be exercised in doing, these kind of consolidation, wind-ups, transfer to make sure that the rollover provision apply.
No more questions? No? Well, thank you, Marie-Andrée. I will now move on with the second topic. I asked myself how to address an audience of mostly lawyers, non-tax lawyers. Some of you may be tax lawyers, and one of the topics that come very often that's, I think, interesting for lawyers is the rectification and the correction of tax mistakes. I'd like to cover this topic from various angles today. First of all, I'd like to just put the context in what is at stake. It's part of not of our everyday practice, but those problems, errors, or corrections of certain contracts often arise in the everyday practice. And also, I'd like to address some potential solutions. There's always the recourse of rectification, the remedy of rectification, but there are various potential solutions that could be reviewed and discussed when mistakes arise. I will then focus mostly on the rectification remedy and obviously provide some best practice advice and for the situations in-house or for some of you who are advisors. Is there anyone in the room who has been involved in rectification? I'd like to know if I need to adapt my presentation or a formal request in court to rectify?
Yes.
Okay.
So familiar with AES and
Good. Okay, great. So what's at stake? There are probably two certainties in life. You've probably heard that, but death and taxes. It's Benjamin Franklin. But as lawyers, we know also that there's another certainty is that contracts are binding. And as a person in life, I'm now 41, there's another certainty is that no one's perfect, not even your tax lawyer. So that's quite a nice mix you have here. You have binding contracts, mistakes, and unfortunately taxes. And with taxes come interest and penalties, usually when they're assessed. So the thing which must be understood is that taxes, when you have a contract, a binding contract, the tax consequences flow from that contract. So tax law is just ancillary to the main contracts and the main obligations. And from there, you have all the tax consequences that flow. Well, most often taxes are owed at a certain time. And if a mistake has been done, we'd like to correct it. But the issue here is that correcting the contracts is not enforceable against third parties or against the tax authorities, because tax authorities are third parties. So if you try to correct an internal contract between two of the related companies, well, it's not enforceable, it's not binding on the tax authorities. So the tax consequences will stay. Very simple example, you have GST, QST that's owed because consideration was paid, or consideration was payable, that's sufficient. Well, even if you try to correct it to say we didn't transfer the right asset or it was not at the right time, well, if the contract says it was payable and the contract is valid, well, you have taxes that is owed, and when it's owed, it's deemed trust, and the government could essentially collect on it if you have a subsequent audit. So the fact of doing internal corrections or internal contracts will not be sufficient to change the tax consequences most often. If you have contracts that are just between two parties and there are no tax consequences, that's rare, but you could do it, and then there's no issue. But what I'd like to talk about here is the interaction of these changes with the tax consequences. How do we make them retroactive? Because that's the issue here. So sometimes there are various remedies that we could use to make them retroactive, and the most common one is essentially rectification that I will talk about. So among the potential solutions, let's say you have a contract here, you you transfer, I'll give an example of you transfer, you divide a business into two companies or two entities. You transfer the distribution assets or distribution operations in one entity and the manufacturing operations in another. You can have multiple mistakes, but let's say some assets were not transferred in the proper entity. The first thing we think about is just to correct the contract, is make an amendment or some form of internal resolutions or corrections, agreements signed as of today correcting previous agreements. But again, as I've explained, this is usually insufficient because it doesn't correct the contracts retroactively. It's only effective as of the time of the change, so that would be as of today, even if a contract was signed a year ago. In unusual circumstances, the tax authorities may accept the change, but most often they don't because they benefit from the tax consequences that flow from the previous contract, which contains an error. The second solution we can look into is rectification. It's under a court order. I will talk about it in details later on. There's also rescission, to rescind a contract. In French, it's résolution du contrat. So this is the contract becomes null and void, and it's essentially it never existed. So that's a retroactive change, but the problem here, it's about restitution of benefits. It causes all sorts of issues when consideration has been exchanged, things have been transferred, and assets have been used for operations. Now, essentially, they go back to the previous transferor, so that creates a lot of issues. It's not a practical solution, but sometimes when you have a multi-million dollars tax liability, you're ready to take that chance and try to avail yourself of the possibility of claiming rescission or résolution du contrat. Another possibility is undocumented agreements. Sometimes there may be a contract where you just need to fill the void. Something was not specifically written, and there may be oral agreements or discussions at the time the contract was signed that essentially constitute an agreement, a meeting of the minds that will supplement or fill the void in a contract. So it doesn't happen very often, but you can think about it. For example, if an asset was transferred by an entity, that entity was acting as an agent for another entity, so that the tax consequences would be those of the principal, not the agent. There are various things that you can look at, but again, it's all a matter of evidence. You need to show, and you need to be able to show the contracts, the agreements, the emails, and what was discussed at the time, and then you could memorialize or document that agreement to fill the void of what was not discussed or put in writing. There are other tax solutions. Marie-Andrée talked about some of them, is the elections and the designations. So sometimes it's just a tax problem, and you have a chance of an opportunity to amend your election or change your designation in a tax return. And there's a discretion on the part of the tax authorities. They're not forced or they're not obliged to accept your changes, but sometimes it fixes the problem. I won't get into that, it's very technical, but that's one of the solutions sometimes when it's strictly a tax problem. For example, you designated an elected amount in the rollover to have no tax consequences, but you could try to change it later on if it's not considered retroactive tax planning. There are other more unusual solutions. It's called remission order under the Financial Administration Act. The tax authorities have the ability to forego or renounce to the tax that is owed if it's unreasonable and inequitable. It's very, very rare. There's maybe 100 applications per year, but the number of cases granted is very, very low. But in chances where it's very unfair, we can review the opportunity of filing for a remission order or filing an application for. And then there's always the legislative amendments. If you know your MP, no, it's submissions to the finance department. If the problem that's causing if the issue that causes the tax consequence is common to other taxpayers and it's unintended, there's a problem with tax policy, sometimes it happens, an amendment can be made, and sometimes it's the amendment can be retroactive. If it's not, well, you're left with the tax problem. It's always a matter of making the change retroactive to the time the agreement was signed. For just a note on rescission, you don't always need a court order. You can use it as a defense. If you wait for the tax assessment, you fight it in court. For example, in Tax Court of Canada, you could, if the contract is void because the conditions were not met or there was an error within the Civil Code of Quebec, an error that vitiates the consent, well, you could argue that, and then the court could recognize that, and the contract would be void, and the tax consequences would be void also. But again, it's rare that you're in a position to do that. Did I mention backdating? No. Backdating, it's a word we don't use, but it's neither bad or wrong. And I've actually covered what is backdating. Backdating is either signing today an agreement made effective as of to recognize an agreement that happened before. That is fine if you can prove it, if you can show that there was a meeting of the mind and everything. Now, if it hasn't happened, that's where the problem is. That's bad and potentially fraudulent, as you know. And that's something we can't do. And so the backdating is a loose word, but in the sense, if you're talking of correcting a contract or memorializing a contract to recognize an agreement that happened in the past, that is fine. And you just made it effective as of. And just for those of you who think that you may sign a contract internally and put a date a year ago without saying made effective as of, well, you can expect that if you have a challenge by the tax authorities, my experience is that when you get to the examinations for discovery, you usually get a lot of questions on when was the contract signed, can you provide me with the drafts, how were they exchanged? So if things were done a year or a year and a half after, well, they're going to know, and then you're going to face the problem. So again, putting in writing an agreement that happened before, if you have the evidence to prove it, that's fine. The rest is very problematic. So this is for the potential solutions, but I'd like to talk now more about rectification. And, I'm okay, sorry. The conditions for rectification they seem simple. You need a prior agreement. It doesn't mean a written agreement, just a prior agreement, whose terms are definite and ascertainable. You need something very precise. The agreement must be in effect at the time the instrument was signed, and there must be an inaccuracy or a discrepancy between the instrument and the nature of the object of the agreement. So the instrument, if it fails to record the agreement accurately because of a mistake, well, then it opens the door to rectification if you can prove all that. And also, if the instrument, once changed, would give effect or would implement the intention of the parties. So it's meant to address a situation where you have a discrepancy between the actual agreement, what was agreed upon, and to do X, Y, Z, and the actual instrument, how it's been written. So the common example, very simple example is, well, I gave instructions to buy a blue car, and they delivered a green car, that kind of example. Those are very simple situations, but they get more complex. And the problem is interpreting what's the object of the contract and what was intended, and whether an intention to avoid tax liability or an intention to have tax neutrality is sufficient. And that's where the case law we'll talk about it becomes relevant. So the rectification is done through a court order. If you just rectify contracts internally, I've talked about it, it's not enforceable against tax authorities. It only changes the effects as of the time of the change. So you need to seek a court order. It's through declaratory relief. A quick word on the sources of rectification in common law and civil law. An there's a convergence of principles. The sources are different. Rectification in common law is an equitable remedy. At civil law, it's a matter of interpreting the contract and the true intent of the parties. And it's grounded in Section 1425 of the Civil Code of Quebec. So it's a matter of interpretation, and in common law, it's an equitable remedy. So there seems to be differences, and there were some differences in the past, but with recent case law that I will talk about from the Supreme Court of Canada, there's really the principles are now analogous, and the Supreme Court doesn't hide behind the fact that they want to have harmony, and for federal law that applies over the country, they want the same principle to apply. They don't want a situation that would allow rectification in one province and not in the other. So that's a few words on common law and civil law. So they're essentially the same now. The benefits of rectification, I've mentioned some of them, and it's important to stop and think about them. It's a retroactive amendment, so the tax consequences will flow from them. The court order will bind the third parties, the tax authorities. And also the transaction is not void. It continues. The contract will stay, it will be amended. Maybe we will change the nature of a consideration, the nature of some obligation within the contract, but it stays, it continues. And it changes from the time it was signed. So it gives more flexibility to fix the mistakes. And it has an impact on tax liability, which is a huge advantage over other solutions. What I want to talk about is really the Supreme Court decisions. The two most recent decisions on rectification is Fairmont Hotels and Jean Coutu. In 2016, the Supreme Court of Canada issued two landmark decisions which changed the way we thought about rectification. And at first, they narrowed down the situations where rectification should be granted. And it's really, as we say, a pendulum shift that results from these decisions. So the previous case law was open to the idea of correcting mistakes when there was unintended tax consequences. So we prepare a contract, we sign a contract for the transfer of the two divisions I mentioned. Well, we didn't foresee that there could be a problem with some foreign exchange gain or loss, but we had a general intention to achieve tax neutrality, or to not to realize adverse tax consequences. There was tolerance towards that. Retroactive tax planning was not allowed, but in Juilliard, the case you mentioned, the two sisters, so in the line of Juilliard and other cases, there was openness to rectify the contracts with unintended tax consequences. And we could read some of the previous cases of the Supreme Court as allowing that too. The problem, well, for us tax lawyers, when we saw those decisions, is that the two decisions were rendered, and the Supreme Court essentially said, you know what, unintended tax consequences are insufficient to allow rectification. Rectification is not about the consequences, it's about what the parties agreed on and whether the instrument is correctly reflecting that agreement. So a general intent to limit tax liability, or if you do in your recitals, like we want to achieve this without tax liability, this is an asset protection plan, and we want to achieve it in a tax-neutral manner, it's insufficient. So from there, the reaction in the tax community was very negative. We thought that, well, essentially we could only rectify, from now on, we could only rectify clerical errors, the terms that are used, and just simple errors. And now with the case law that I will talk about, it's been 4 years now, and there were cases released, and it's more subtle than that. It's still more strict. When it's about unintended tax consequences, it's still not allowed. But if the tax consequences were specifically considered and agreed upon, and then there was a problem or an error, then it's still open, and I will give you some examples later on. So just to give you an example of what was done the topic of those decisions, the facts. In Fairmont Hotels, there was an acquisition of two hotels through Legacy Hotels. So it was a company that Fairmont had an interest in. And so there was a financing arrangement in US dollars that was put in place to acquire these two hotels. And because of the foreign exchange exposure, there were reciprocal loans that were put in place to prevent essentially to have a hedge, a natural hedge on in respect of this financing arrangement, not to trigger foreign exchange gains or foreign exchange losses, mismatch. There are a huge problem. So they put that strategy in place. And essentially, there were an acquisition by Kingdom Hotels later on in 2006. And that acquisition triggered other foreign exchange gains and losses issues. So there was another plan that was devised to shield Fairmont from this foreign exchange exposure, and also at the time, because of the acquisition and subsequently to put that in place. The problem is that plan was not implemented with respect to the two subsidiaries that were involved in the acquisition of the hotels I mentioned. So a year later, after the acquisition, there was a quick request by the subsidiaries they were selling the hotels, and they wanted to buy back the shares of the preferable shares that were owned by Fairmont. So there was a quick request to buy those shares, and what happened is that they didn't realize that the plan that they had put in place before didn't apply to those subsidiaries. So a foreign exchange gain was triggered at the time. So then they tried to seek rectification in court, say, well, we made an error, it was not intended, and along the lines of previous cases, there was a fair chance at the time that this would be allowed. When it came to the Supreme Court said, well, if it's only a general intent here, and there may not even be a general intent, because when you change the foreign exchange arrangements to shield the Fairmont, you didn't implement it with respect to the subsidiaries. So although you may have had a few years before a general intent to achieve tax neutrality with respect to foreign exchange gains and losses, well, it's insufficient. It's just a general intent, and rectification doesn't allow that. So that's an example. It's with respect to foreign exchange gains. In Jean Coutu, it was the acquisition of U.S. pharmacies, and there were also hedging arrangements. There was the parties put in place reciprocal loans. So one of the entity was both a debtor and a creditor of U.S. loans. But what they didn't realize, there was an upstream loan to the Canadian company, and this creates FAPI. So there was passive income that was triggered or realized in the foreign subsidiary, and that was imputed to the Canadian company, creating tax. That was not foreseen initially. And again, using the same line of argument, they said, well, it was unintended, we didn't look into it. Well, again, the court said it's not, rectification does not allow that. And they specifically said, had the parties turned their mind to the FAPI issue, and well, if they had turned their mind to the FAPI issue, maybe they would have corrected it or made what's needed to avoid it. But had they turned their mind, and if there was a plan to achieve neutrality or not to create FAPI gains, and then there was an error in the implementation of the contracts, well, that would have allowed the rectification. So that's the difference between general intention, general tax consequences like an intention to achieve tax neutrality versus specific, very precise, determinable intent to achieve a certain tax result. And just to give you an example what the Supreme Court came up with, and you can see it in the citation there. So whether the error is said to result from a mistake common to both or all parties to the agreement, rectification is available upon the court being satisfied that on a balance of probabilities, there was a prior agreement whose terms are definite and ascertainable. In Quebec, it's determinate and determinable because of the civil code, but it's the same. So if it's precise with respect to the tax obligation, the tax result, that's okay. So that the agreement was still in effect at the time the instrument was executed, and the instrument fails to accurately record the agreement. So in those circumstances, if the correction that is sought would achieve the taxpayer's intent or the party's intention, that is sufficient, and rectification should be allowed. So, as I said, when it came out, we thought we would be flipping burgers. No, but tax lawyers every 2-3 years, there's always a nuclear bomb, and like tax proposals or something. We always think that tax practice is going adrift, but no, it was the fear that we had initially. I don't think it's founded, as you will see from the subsequent case law. So, what I'd like to cover maybe what's allowed, what we can do, and what we cannot do. So there are favorable situations. The most easy ones are the term is omitted. We name a party, or the shares of a company will be transferred, and we forget Canada and Super Canada Inc. The Canada is omitted, so the shares are maybe another company in the group, or that's not a problem if you can show that the intent was to transfer that company. An unwanted term. It's a promissory note. We put demand promissory note. It wasn't the intent because we use a precedent or something. Incorrect intent, there's a resolution of trustees. The intent is to make a capital distribution, but again, we use a resolution and it's a income distribution. It's quite different in terms of tax consequences. One is taxable, the other is not. And so those situations are fairly easy and would open the door to a rectification. When it becomes more tricky is, as I said, when you have situations that involve tax consequences. There are examples with capital dividends. Capital dividends, the essence of the capital dividend is that it's not taxable. It's a resolution that we hereby declare a dividend that will be a taxable dividend, a capital dividend under 83.2, and then usually we state the balance of the capital dividend account. So there's a recent case in 5551928 where there was an error made due to the accountant's error. There was an error in the balance of the capital dividend. It was a timing issue, and they didn't wait until the end of the year, so the balance was much lower than anticipated. So this triggered a 60% tax, which is quite high when you miss your target on the balance of the capital dividend account. And what happened, essentially, they were assessed for that, and they sought rectification, and they actually obtained the rectification because the court said it's very specific. What you sought as the obligations you wanted to not the obligations, but the object of the contract and the resolution to declare a non-taxable dividend, and the intention that the dividend be non-taxable was stated in various documents. The evidence is clear, it's very precise, definite, ascertainable. We allow rectification. That's allowed. Rollovers. Well, it depends where you go. There are rollovers in Juilliard, but there's also another case, AES, Services Environnementaux from the Supreme Court of Canada. We thought that Fairmont and Jean Coutu were kind of overruling or distinguishing that case, but they tried to harmonize them. So rollovers, technically, in most cases, if the intent is to achieve, for example, to issue promissory note on a rollover up to the threshold, you can issue a promissory note up to the ACB, the cost of the shares that are being transferred. If you miss the target again or the threshold because of an error of the accountant, that was allowed in IAS, and the Supreme Court said specifically that no, we're not distinguishing IAS. It's still allowed because the obligations and the results, the tax results, was very specific in that case. Other favorable situations. The share purchase agreement, transactions with a specific tax treatment, sometimes that's where it becomes more of an interpretation and evidence issue, because you may have a more general intent to achieve a result, a tax-neutral result. Some cases, mostly in the West, mostly in BC, and I will talk about that later on. There's a bit of a different approach to rectification. It was allowed. So the Crean case is essentially a sale of sale of shares among two brothers, and the intent was that there was a promissory note that was issued, and that triggered a dividend. But the taxpayer was able to show that within the transfer, the plans that was to be implemented, it was a capital gain treatment. So the objective of the transaction, but not just the objective, what they agreed upon was to have a capital gain treatment, and that deemed dividend, because of 84.1, it was not achieving that result. And so the court found, based on the evidence that was there, what was shown in the specific agreement to achieve a capital gain treatment, well, they allowed the rectification to change to avoid the dividend, or the deemed dividend was triggered because of the way the transaction was done. In Biting, it was again, it's another reorganization. There was a transfer of two parcels of land. The parcels of land were transferred to an individual, and that triggered tax consequences because they thought they were transferred to the company, and they thought that the shareholder loan or the amounts that the taxpayer could use from the company, pull out of the company tax-free through the loans, was higher than it was actually, because the parcels were transferred to the individual. But they showed all the documents, all the planning documents from the accountants and from the lawyers, all the intent that no, there was the whole plan was that the house and the first parcel was to go to him personally, and then the other parcel was to go to the company. So by showing with proper evidence what was the intent, what was agreed upon, then the court opened the door to rectification, and it was allowed. When we have unfavorable situations, I've given examples in Fairmont and Jean Coutu. There are other examples and recent examples. If you have unanticipated tax consequences, like the FAPI I've mentioned, a consequence that was not foreseen, you're dead. It's really, that's the state of the law, and I haven't seen cases where it's allowed. That's what the Supreme Court said, and all the judges are very aware of that. So in Technicom Solutions, it's a matter of there were distributions made over the years. Distributions were recorded in the books of the company as loans, and there were attributes that to be used to make sure they would have been capital distributions or PUC reductions, paid up capital reductions. So the taxpayer tried to use a rollover that was implemented a few years before to say, well, the intent was a general intent to achieve tax neutrality, and there was an intent to use the tax attribute that was created in the distributions, subsequent distributions, to make them non-taxable. And the court looked at that and said it was just a general intent. It's not because you have a tax attribute that necessarily all the subsequent distributions will be non-taxable. There's no link between the two. You could have used them, but what's recorded, what was done over the years is loans that after a certain time when they remain outstanding, it becomes taxable in the hands of the shareholders. So the rectification was not allowed. And he said, again, this is what I mentioned before, rectification does not speak to plans or objectives. It's about what the parties agreed upon. And you can't show me here that you've agreed to achieve non-taxable distributions. In Canada Life, it's another situation where it involves a rollover, actually, but it was not foreseen. And the parties had, again, it's very often foreign exchange exposures. So there was a partnership interest that was owned by the taxpayer, and that partnership interest, there was an unrealized loss that would have been triggered, and they had hedges that, in respect of which accrued gains were to be realized. And he wanted to match the two of them in the same year. There was a mismatch because of the way the transactions would go. So they devised a plan to use the unrealized losses against the gains. And in doing so they wanted to trigger the loss and the gains. But the problem is they forgot about 98.5. 98.5 is this rollover for partnership windups, and they forgot about that. And it was simply not analyzed, not reviewed. And again, it's the same situation where the parties didn't see it, didn't look at it. So there was no specific intent to achieve a specific tax result with respect to that provision. So it was insufficient. So it's an error on the part of the professionals. An error in judgment is not sufficient to allow rectification. It used to be the case. There was some tolerance, as I said, but now it's very strict. The consequences resulting from changes in the law, that's another example. In Collins Family Trust, there was a common planning using a trust in a company, and the operating company would pay dividends to the trust, and because of some attribution rules, the income would be attributed to another holding company, but because it's intercompany dividend, they're not taxable. So they were pulling out money or stripping a company with putting the money in the trust, but that was not taxable because for tax purposes, the income was allocated to the holding company. So that worked for some time until there was a decision by the Supreme Court of Canada that said one of the conditions not met, so the plan fell. So the CRA started assessing some taxpayers, including Collins Family Trust. And so they sought rectification, saying, well, we didn't foresee that, we wanted to achieve tax neutrality, and there were very specific lots of documents saying we want to achieve protection of assets on a tax-neutral basis, and it was all over the place. But that was insufficient, especially in a situation where there was a subsequent change in the law. So the fact that it was an unforeseen consequence is not sufficient. That's another example. Elements that are not considered in planning transactions. I have 4 minutes, or okay. I think you get the message. Be specific. You have to have precise and definite, ascertainable obligations and results that you want to achieve, and that is when it opens the door to rectification if there's an error in the documents that are drafted afterward. I won't mention the other cases, but they're along the same lines, and there's a discretionary decisions when the trustees make a decision, and then there's a change or a change in the facts, and they say, oh, we made a wrong decision. Forget it. If you make an error in respect of parties, you better wake up early to convince the court that it was an error. But in Biting that I've mentioned, there was such an error, but they really showed the documents. In 2794209, they just weren't able to show that there was an intent to do that, and there were conflicting views, and they weren't able to explain why there was an error. So it's because of evidence, the result were much different. So just to mention, the last point that I'd like to mention is about best practice. If you seek a rectification order, don't think that you can do this on your own with a judge in a room of the Palais de Justice. You need to notify the tax authorities. They must be put as parties in the proceedings, in the pleadings. Otherwise, it's not automatic that it won't work, but I'm telling you, you're running into a lot of troubles, and they won't recognize it, so they won't issue reassessments to correct the mistakes you're trying to correct, and the tax consequences. I'm sure you get that message, but you need to properly document or memorialize the taxpayer's intentions. That can happen at several places in the planning and implementation phases. In the transactional documents, a good place, all the recitals. Well, in the recitals, you can use self-serving language. It's worth something. It's evidence that the parties agreed upon. Also in the planning documents, if you have a tax planning memo, it should be reviewed and agreed upon, even signed by the taxpayers, the directors of the company, to show that they've agreed to achieve this particular result, not just the taxpayers were working by themselves in one room and not talking necessarily to the executives. It needs to be reviewed, agreed upon, and the more examples and evidence you have of that agreement to achieve a specific result is good for you if ever comes the time of seeking a rectification order. There are also documents confirming instructions, a letter of mandate, we'd like you to achieve X, Y, Z result, and it could help to state the intention. Severance clauses, rapidly, it's just that, those typical clauses we use about if a portion of the contract is void, the other one will remain. It's always a good thing to do to prevent problems. Cancellation and adjustment clauses. I could give a whole presentation just on that, but the clause résolutoire, there's a bit of uncertainty whether it works, but if the tax result is so important, you may think that, if it's not achieved, this transfer is void. That's a possibility, but again, there are problems with restitution of benefits. You need to think ahead. Then you have price adjustment clauses that are very common mechanisms. If you follow the tax authorities' guidelines, they will agree to implement them, but they're not always enforceable. There's some uncertainty as to whether other adjustment clauses would be enforceable against the tax authorities, but at least it will give you good evidence of an intention to achieve a tax-neutral result or a specific tax result. The jurisdiction of contracts, my experience, what I read, what I see is that if you're in BC or Alberta, your chances of getting rectification are still much better than in Quebec. So I'm not saying that you can change the jurisdiction of contracts like you want. If you won't put Idaho between two parties in Quebec, but if the situation allows, if you have a chance of using contract under BC law or under Alberta law instead of Quebec, I would think about it. It depends on all sorts of circumstances, but it's worth thinking about it. And the record retention policies, most of the cases, it's all about evidence. I run into problems. A lot of cases we do, unfortunately, you try to find the evidence, emails, anything that would support your theory of the case or support the claims you make. And very often, and companies seem to be destroying emails. The employee leaves, okay, it's destroyed within 1 year. The emails of the employee or documents. The record retention causes a lot of issues and problems in proving our claims. And that's the case too for rectification, because it's so important to show the original intent and that the instrument that was drafted does not reflect that agreement. And that agreement, you need to show what it was, because sometimes it's verbal. Or so you may have traces in emails that it was a definitive agreement. It's not sufficient just to show up in court with a witness. You need to back up your claim, because almost invariably the tax authorities will object to the rectification order. They will object to it, and that's their policy. And if you have the proper evidence, then your chances of getting the order are much higher. The key takeaways: when there's a will, there's a way. So it's all about the intention. I know it's a common saying, but if you can show the intent or the intention or the agreement, well, there's usually a way to seek rectification. That's what I'm saying here. Stating the intent in writing clearly, specifically, think about them when you have an opportunity, including the advisors, tax advisors. We should do it. And there's a limited effect of internal corrections. Don't think there's a quick fix by changing the contracts. I'm not talking of a closing sessions and we realize that, some signatures are incorrect and all this, but if you find an error like 3 months, 6 months after, and there's a problem, just think that if ever the tax authorities find out that it's been changed, well, it's only effective as of the time of the change, and multiple tax consequences can flow from there, and most of the time they're adverse tax consequences. And expect developments in the case law. It's still difficult to draw a clear line between what's allowed and what's not. Fortunately, it's been 4 years, and I've explained there are some guidelines that we can get from the courts, and it's maybe more, rectification seems to be more available than we initially thought, but you can expect developments in similar situations, so it's a topic to follow in the upcoming years. Thank you.